Hello. In this presentation, I'm going to cover the guidance issued by FASB over management's responsibilities in situations where there is uncertainty about an entity's ability to continue as a going concern, what that might mean for the entity experiencing this, and some tips for management to keep in mind when facing such a situation. Prior to the issuance of the Accounting Standards Update in August of 2014, there was no clear guidance on the going concern concept in generally accepted accounting principles. With the new update, FASB hopes to reduce diversity in the timing and content of footnote disclosures that had been previously noted. The first step by FASB was to define the term substantial doubt. Per the update, substantial doubt about an entity's ability to continue as a going concern exists when conditions and events, considered in the aggregate, indicate that it is probable that the entity will be unable to meet its obligations as they become due within 1 year after the date that the financial statements are issued. For management, this makes a requirement that for each annual reporting period, an evaluation must be performed to determine whether conditions and events exist that raise substantial doubt about the organization's ability to continue as a going concern. Some examples of these conditions and events could include defaulting on debt, negative trends in operating results such as recurring losses or negative cash flows, loss of key employees or labor difficulties, significant legal proceedings against the organization, or loss of a major supplier or significant revenue stream. Remember, these conditions are considered in the aggregate. Once it is determined that they give rise to substantial doubt, management must provide the auditors with its plan to mitigate the effect of such conditions. Common strategies that can be included in management's plan include debt restructuring or other plans to borrow money, delaying or reducing expenditures, or disposing of assets. An evaluation is then made as to whether it is probable that management's plans will be effectively implemented. Further, it must be assessed whether the plans that are probable of being implemented are likely to mitigate the conditions or events that raise substantial doubt about the entity's ability to continue as a going concern. Whether or not the auditor believes the plan is adequate to alleviate substantial doubt, the financials must include disclosures to inform readers of the principal conditions or events that raise substantial doubt, management's evaluation of the significance of those conditions or events, and management's plans that either alleviate the substantial doubt or were intended to mitigate the conditions which raise the substantial doubt. When the plans are not expected to be effectively implemented or alleviate the substantial doubt, a statement indicating that there is substantial doubt about the entity's ability to continue as a going concern must be added. Although not a death sentence, management should prepare for an adverse response to receiving an explanatory paragraph in the auditor's report describing an uncertainty about their ability to continue as a going concern. Beyond the expected reaction from the organization's board, it is not uncommon to see a subsequent decrease in contributions, particularly in funding through government grants. On the other hand, studies have shown that there is little correlation between a going concern audit report and an organization's receipt of public support. In all likeliness, this may be due to the small number of donors who actually take the time to read the audited financials of the MPOs they choose to give to. In any case, the best response by management in a going concern situation is to remain calm and work with their auditors to ensure they provide them with as much evidence as they can to alleviate the substantial doubt. If management feels a going concern discussion is forthcoming, the best idea is to be proactive and develop a plan prior to the start of the audit. The more prepared that management is both physically and mentally, the less stress it will cause during the audit and the better chance of avoiding a modified audit opinion.